let's invite Abneesh now. He's Abneesh Roy, the Executive Director at Nuvama Institutional Equities, to talk more about the consumer sector. Abneesh, before we get to ITC, on Titan, we just got the Q3 update. The overall sales growth 20%, 24%, jewelry 26%. But I remember the concern in Q2 was on margins, and they downgraded their margin guidance, citing competition. How did these numbers, stack up versus your expectations for Titan?
Yeah, I think it's a decent set of numbers by Titan. Clearly, marriage season and the festival season and the strong gold pricing is helping Titan and other jewelers. You're absolutely right. The concern on margins continues to remain. But my sense is now base becomes a bit more favorable. In first half, the base was adverse. Also, with a 25% kind of a growth, they can get some level of operating leverage also kicking in. Here, what we need to see is how the gold versus the studded share is. Because studded generally, obviously, is higher margin. That and competitive intensity, that has been the key concern for Titan. So overall, I think sales numbers are decent, but I think largely as per expectation. And my sense is other jewelers also should see good numbers because of these reasons, gold pricing and strong marriage and festival demand.
Okay, all right. That's Titan. And of course, gold jewelers, which have had a pretty good showing. Now on to the other news, the big one, Abneesh, and that's ITC, right? We're looking at the demerger of the hotel business finally getting in motion. What is the kind of valuation you're ascribing to it? And, X of the hotels business, what do you see ahead for ITC, the rest of the businesses themselves? I mean, I'm just trying to understand whether as a shareholder, you'll be more optimistic on the X of the hotels business or hotels or both.
Yeah, so hotels business was a very small part of ITC's overall SOTP. It is not that we were not doing SOTP. But yes, I think it's good win-win for the shareholders also and for the company also. So we expect that the hotel, once it gets listed, say in February first half, we expect around 35,000 crore kind of market cap for ITC hotel business. And today, of course, ITC stock should account for that. So you'll see some technical correction there. We expect around 15 rupee kind of a correction in ITC main company. But ITC currently will not be in our top picks. We continue to like from longer term, but February 1st union budget is a key monitorable. Our personal belief is probability of a sharp tax hike in cigarettes on February 1st is very low, given the illegal industry continues to remain concerned. And even in Q3, we expect 3.5% volume growth for cigarette. So I think the rational tax industry for cigarette is the right way for the government and for the customer. But overall, Q3 results for ITC will be a bit muted. We expect almost flattish EBITDA because FMCG business is likely to see profit decline because of the palm oil sharp inflation, because of the maida sharp inflation. And even paper business will see weak numbers. So overall, ITC good from long term. But currently, our topics will be essentially United Spirits, United Breweries, Marico, and Pidilite.
Okay, all right. Hi, Abneesh. Thanks a lot for joining in. Just a couple of details. The ITC stock price today corrects by around, adjusts by around 15 to 20 rupees. Is that correct?
Yes, that is our expectation.
And what kind of value do you ascribe to the hotel business? If you could give us that share price number, and also what multiple are you giving it? Because you have Indian hotels that gets the premium, and then the other players, they get anything between 15 to 25 times. So what value are you giving to ITC hotels?
Yes, so in our view, ITC hotels, once it starts trading around 35,000 crore kind of market cap, and we think the industry and the street could value at around 25 to 30 times EV EBITDA, given it's much larger than most other peers. Of course, Indian hotel is bigger. And we see that around 150 rupee to 175 rupee could be the price of ITC hotels once it gets listed.
Okay, we just had Jubilant Food as well that came out with a set of numbers, which looks pretty okay. The stock is at a fresh 52-week high. What's your view on the counter?
So clearly what we are seeing is market share gains for Jubilant Foods are happening. If you see even past few quarters, the numbers are improving, and the gap with Pizza Hut, when you see numbers of Devyani, etc., Sapphire, etc., clearly gap is for Domino's is increasing. Second, the stock has also done well apart from the recovery in the same-store sales growth and delivery format. Of course, at the promoter level, what's happening at the Coca-Cola franchisee, that is also interesting development. And now my sense is clearly we will see Coca-Cola getting sold inside Domino's stores also. So clearly we are seeing Jubilant Foods, lot of optimism, lot of positivity. And this kind of number is a good number. You have to note that it is now almost 8 quarters of slowdown which the QSR industry has seen. So that has brought the base effect clearly. But we are seeing this quarter that Avenue Supermart also positively surprised, and Domino's also clearly positively surprising. So clearly market share gains are possible for these very well-run companies. So Q2, if you see Avenue Supermart, investors were not happy, but I think they know how to come back, and we have seen 10 stores getting added in Avenue Supermart, and they have done well, 17.5% sales growth. So I think Jubilant Foods, we remain positive from longer term. Of course, valuation comfort is low there. The stock has done well, but it's a good number for Jubilant Foods, same store sales.
But do you think QSR as a space is now turning around after 8 quarters of subdued growth? We saw Jubilant's numbers, but what about for the rest of the pack, like a Sapphire Foods, Restaurant Brand, etc.?
Our sense is clearly 8 quarters of slowdown means that the base has become favorable. So I think the worst is behind. But this kind of a strong numbers for Jubilant Foods, I don't think the other players are currently seeing. This is more of a delivery format doing well, in which clearly Domino's is the number one player. And previous quarter also, if you see within Domino's also, the in-store dining was not as strong as the delivery format. So this is more of market share gain. They have done well in terms of pricing. They have made free delivery options being there. So I would say that this is more of a Domino's specific, but yes, 8 quarters of slowdown does mean that the base has become favorable, and you will see gradual recovery, but not this kind of a number for other QSR in December quarter.
And what's your target price for Jubilant Food?
The numbers have come, and we'll see how the overall EBITDA, etc., pan out. But from a longer term, we are positive. But currently, our top picks in that space will be more like Trent, V-Mart, etc.
What about Dabur and Marico? What were your key takeaways from the business update?
So we continue to prefer Marico. If you see in FMCG, clearly the mid and top end of urban is still doing quite well. The problem is the lower end. So Dabur, if you see mass consumption, so clearly there the impact is there. Impact of Campa Cola is also there. You will see the same thing pan out for Tata Consumers weak numbers in NourishCo in Q3. Although they'll see good volume growth in NourishCo, overall they will see sales decline in NourishCo this quarter also. So we are seeing that Campa Cola impact and the lower end of the urban consumption is an issue for Dabur. Marico, if you see good set of numbers, so we would be quite positive on Marico from a near-term, medium-term perspective. Stock has done well, but for Marico, 6% volume growth and 15% sales growth is a good number. Now, some investors may see that gross margin pressure, EBITDA margin pressure, but that is how Marico operates. So when sharp inflation happens, they take pricing, but they also go for market share expansion. So we are positive on Marico. Our sense is for Nestle, etc., I think still valuation correction has happened, but triggers are missing. For urban-focused companies, I think clearly triggers are still missing. But Marico has done well because they cater more to the mid and top end of the urban consumption, not to the lower end of the consumption in their foods and personal care.
Okay, so perhaps Marico, the stock to watch in this FMCG earnings season. Got that, Abneesh. Thanks very much for joining in and giving us a color on some of the updates that have come through, and of course, ITC as well. Really appreciate you joining us on the show today.